What if I told you that some of the richest people in the world almost never sell their stocks? Not because they cannot, but because selling would actually make them poorer. That sounds strange at first. After all, most people believe that the purpose of investing is to eventually sell your investments and take the profit. You buy stocks when they are cheap, you wait for them to go up, and then you sell them for cash. That seems like the logical end goal. But for many billionaires, selling their assets is actually the last thing they want to do. Think about this for a moment. Some of the wealthiest individuals on the planet have fortunes worth tens or even hundreds of billions of dollars. They own luxury homes across multiple countries. They travel in private jets. They fund massive business ventures, and sometimes even space companies. Yet the majority of their wealth is not sitting in a bank account. Instead, it is locked inside stocks and company shares. For example, most of the wealth of Elon Musk comes from shares of Tesla. In the same way, a huge portion of the wealth of Jeff Bezos comes from his ownership of Amazon. These stocks can be worth billions, or even tens of billions of dollars. But here is the surprising part. Even though they are worth so much, billionaires rarely sell them. Instead, they hold on to their shares for years. Sometimes, for decades. So the question becomes obvious. If billionaires do not sell their stocks, how do they pay for their lifestyles? How do they fund massive projects? How do they access billions of dollars in spending power without liquidating their assets? The answer reveals one of the most powerful financial strategies used by the ultra-wealthy. And once you understand this strategy, you will start to realize something important. The financial system often works very differently for people who own assets compared to people who only earn income. Today, we are going to break down exactly why billionaires avoid selling their stocks, how they still manage to access huge amounts of money, and what this strategy can teach us about how wealth actually grows. Most people grow up believing a very simple version of how money works. You earn money from a job, you save some of that money, then you invest it in things like stocks or real estate. And when you need cash later, you sell those investments. That idea makes sense for most people because it is the only system they ever see. But this model has a serious problem. When large amounts of money are involved, selling assets creates taxes, a lot of taxes. When you sell an investment that has increased in value, the profit is usually taxed as a capital gain. Depending on the country and the tax laws, this can take a significant portion of the money you earned. Let us imagine a simple example. Suppose you bought stocks for $10,000 many years ago. Over time, those stocks grew in value to $100,000. If you decide to sell them, you made $90,000 in profit, but you do not get to keep all of that. A percentage of that gain must be paid in taxes. Now imagine this situation at a much larger scale. If someone sells $1 billion worth of stock, the tax bill could easily reach hundreds of millions of dollars. That is an enormous amount of wealth, disappearing instantly. For billionaires, this creates a huge problem. Most of their wealth is tied up in assets, such as company shares. If they sell those shares to get cash, they immediately trigger massive tax obligations. And there is another downside. Selling stock also means giving up ownership. Ownership of powerful companies is often what allows their wealth to grow in the first place. Once they sell those shares, they lose future growth, so selling creates two major losses. First, a large portion of the money goes to taxes. Second, they give up ownership of assets that could continue increasing in value. For someone thinking about long-term wealth, this is a terrible trade, and that is exactly why the ultra-wealthy look for alternatives. Instead of selling their assets, They use a strategy that allows them to access cash without triggering those massive tax bills. This strategy is often summarized in 3 simple words: buy, borrow, die, and understanding. How this works reveals a completely different way of thinking about money. The strategy used by many wealthy investors is surprisingly simple once you understand it. Instead of selling their assets, they borrow money against them. This works because valuable assets can be used as collateral for loans. Think about how mortgages work. When someone buys a house, the bank lends money because the house itself acts as collateral. If the borrower fails to repay the loan, the bank can take the house. Stocks can work in a similar way. If someone owns billions of dollars worth of stock in a successful company, banks are very comfortable lending money to them. Why? Because those shares have enormous value. If the borrower fails to repay the loan, the bank can claim some of the stock. This makes the loan relatively safe for the lender. So instead of selling shares to get cash, billionaires simply borrow money. Using their stock as collateral, this gives them access to large amounts of cash while still allowing them to keep their ownership. But the biggest advantage comes from how taxes work. Loans are not considered income. That means borrowing money usually does not trigger income taxes or capital gains taxes, so the billionaire receives cash but avoids the massive tax bill that would have come from selling their assets. At the same time, they continue to own the stock. If the stock keeps growing in value, their overall wealth keeps increasing. Another interesting detail is the interest rates on these loans. Because the borrower is extremely wealthy and the collateral is valuable, banks often offer very low interest rates. In some cases, the interest rate can even be lower than the average rate of inflation. When that happens, the real cost of the loan becomes very small. Meanwhile, the value of the underlying assets may continue rising over time. This creates a powerful financial loop. The billionaire keeps their assets. Those assets continue growing. They borrow money when they need liquidity, and because the assets grow faster than the cost of borrowing, their wealth continues increasing. This system allows the wealthy to maintain control of their assets while still accessing large amounts of money. And that is one of the biggest differences between how ordinary investors and ultra-wealthy investors manage their finances. To understand how this works in the real world, let us look at a few well-known examples. One of the most famous cases involves Elon Musk. For many years, the majority of his wealth came from shares of Tesla. At times, those shares were worth well over $100 billion. But that does not mean he had that amount of money sitting in a bank account. His wealth was mostly tied up in company stock. If he wanted to turn large portions of that wealth into cash, selling shares would have triggered huge tax bills and reduced his ownership in the company. Instead, wealthy founders often use their shares as collateral for loans. Banks are willing to lend large sums because the underlying assets are extremely valuable. Another example is Jeff Bezos. Most of his fortune comes from his ownership of Amazon. Over the years, he has sold small portions of his stock for specific purposes, but the majority of his wealth remains invested in the company. Many ultra-wealthy founders prefer to keep ownership of their companies rather than liquidating their holdings. Another well-known example is Larry Ellison. Reports have shown that a significant portion of his shares in Oracle Corporation have been used as collateral for personal loans. This allows access to large amounts of liquidity, while still maintaining ownership. Even legendary investor Warren Buffett is known for rarely selling strong, long-term investments. His philosophy is simple. If you own a great asset, holding it for decades allows the power of compounding to work. Selling stops that compounding. That idea explains Why many of the richest people in the world focus on holding valuable assets rather than constantly trading them. Ownership is what creates long-term wealth. So what can we learn from this strategy? The first lesson is that wealth is usually built through ownership, not through income alone. Most people focus on earning a salary, but the wealthiest individuals focus on owning assets. Assets such as businesses, stocks, and real estate have the potential to grow in value over long periods of time. When you own these assets, your wealth can increase even while you are not actively working. The second lesson is understanding the power of compounding. When a strong asset grows year after year, its value can increase dramatically over time. But if you constantly sell your investments, you interrupt that compounding process. Holding valuable assets for long periods allows them to multiply in value. The third lesson involves the strategic use of debt. Many people see debt as something dangerous, and in many cases, it can be. But in the hands of experienced investors, debt can also be a financial tool. When used responsibly, borrowing against assets can provide liquidity without forcing you to sell your investments. Of course, this strategy is not something everyone can use at the same scale as billionaires. Banks are far more willing to lend large sums to people who already own enormous amounts of wealth. But the underlying principle still matters. Building wealth is not just about earning more money. It is about acquiring assets that grow over time. The richest investors often think in decades. They focus on holding great assets, minimizing taxes, and allowing their investments to grow. That mindset is very different from short-term trading or constantly chasing quick profits. And that difference in thinking often explains why the gap between wealthy investors and average investors can become so large. Understanding how the wealthy manage their assets can completely change the way you think about money. Many financial strategies used by billionaires are rarely explained in schools or traditional financial education. Most people are taught to focus on earning income and saving money. But the truly powerful financial strategies often revolve around ownership, leverage, and long-term growth. When you start looking at money through that lens, you begin to see the financial system in a different way. Instead of asking how much money you can earn this month, the more important question becomes what assets you can build that will grow over time, instead of thinking about selling investments as quickly as possible. You begin to think about which assets are worth holding for decades. And instead of seeing debt as something purely negative, you start to understand how it can sometimes be used strategically. Of course, the scale at which billionaires operate is very different from what most people experience, but the core principles behind their strategies are still valuable to understand. Ownership matters. Compounding matters. Long-term thinking matters. And once you understand these ideas, you start to see why many of the wealthiest people in the world structure their finances the way they do. Because the goal is not simply to make money, the goal is to build systems that allow wealth to grow continuously over time. That is how fortunes are built, and that is how they are preserved across generations. If you want to understand how money actually works, how billionaires structure their wealth, and how the financial system operates behind the scenes, make sure to subscribe to The Geeky Investor, because on this channel we break down complex financial ideas in a simple and clear way. And the more you understand how money works, the better decisions you can make with your own financial future. I will see you in the next video.